Hello and welcome. This lecture video I'm going to continue talking about these transactions 6 and 7. They got cut off a little bit on the prior lecture video. And I'll also talk about the financial statements, okay? So again, what we talked about, we concluded the last lecture video by looking at these two transactions, the payment of expenses in cash. The company pays $1,000 rent, $700 in salary. Those are expenses. These are costs of doing business. And so what's happening here is that cash, which is an asset, is going down because we're paying it. So cash as an asset is going down. You can see down here in the figure. So I have $1,700 cash. My total cash is now $4,000. And then these are expenses. Okay, so expenses reduce equity. So if you look over here, remember I had my equity in the prior problem. I had $34,200 of equity. Now I have $30,000, which is the initial capital, plus the revenues of $4,200, minus the $1,700 of expenses. So my total, I would figure out my total equity by taking the $30,000 plus the $4,200 minus the $1,700. That would give me my total equity. My liabilities are unchanged at $7,100, and I still have the equipment at $26,000. So when I add my cash of $4,000, my supplies of $96,000, my equipment of $26,000, I get $39,600 total assets. Then on the liabilities and equity side, I have my accounts payable still, $7,100, my capital of $30,000 plus my revenues of $4,200, and then expenses decrease equity, so I subtract my $1,700 of rent and salary expense to then give me my total liabilities plus equity equals my $39,600, and then the accounting equation assets equals liabilities plus equity stays in balance. Okay, so now let's talk about the financial statements. Okay, and there's 4 financial statements that we're going to talk about. And these financial statements are the way that we communicate information to our internal and external users. So the first one that I want to talk about is the income statement. And this would be the first one that I do. Okay? So the income statement shows a company's revenues and expenses along with net income or net loss. So revenues minus expenses equals net income. Revenues minus expenses could also equal net loss. Now, net income would be the situation where revenues are more than expenses. Net loss means expenses, your costs of doing business, are higher than your revenues. Revenues minus expenses gives us net income. So if we look at our company here, our fast forward, we had consulting revenue of $5,800. We had rental revenue of $300. That gives us our total revenues of $6,100, minus our rent expense of $1,000, minus our salaries expense of $700. That gives us total expenses of $1,700. Total revenues of $6,100 minus total expenses of $1,700 gives us net income of $4,400. So that's the income statement. Shows us our revenues and expenses during the accounting period, and then revenues minus expenses gives us our net income. The next financial statement that we would complete is our statement of owner's equity. And this shows us our 4 components of equity, right? It shows us our beginning balance in equity, and then shows us the 4 components, so those 4 accounts that affect equity: owner's investment, owner withdrawals, revenues and expenses, which is net income. And then it shows us our ending equity. So it shows really how we got from beginning owner's equity to ending owner's equity. Okay? That's what I'm saying over here. Explains those changes in equity from net income and then owner investments and owner withdrawals over the accounting period. Okay? So if we look over here at our next page, page 16, we have our income statement that we talked about before, the $6,100 of revenue, minus $1,700 of expenses gives us net income of $4,400. And then we can look at that $4,400, revenues minus expenses, is an input to our statement of owner's equity. That's why I was saying you have to do the income statement before you do the statement of owner's equity, because you need to know net income to do the statement of owner's equity. So our statement of owner's equity, we start off by saying here's our beginning balance in capital plus our $30,000 investment by the owner plus our net income less our $200 of withdrawals gives us our ending balance in equity of $34,200. And it says C. Taylor Capital, December 31st. Our ending balance in equity is indicated by C. Taylor Capital, $34,200. How did I get that again? Zero balance to start off with. Chaz Taylor invested $30,000, so owner investment went up by $30,000. We know that revenues and expenses influence equity. Revenues increase equity, expenses decrease equity. So I can just take my net income, which is my revenues minus my expenses, and add that to my owner investment. And then we also know that owner's withdrawals decrease equity. So I take my owner capital of $30,000 plus my net income of $4,400, subtract out my owner withdrawals of $200, add that to my beginning balance of zero for a beginning balance of equity, equals my ending balance in equity of $34,200. Okay. Now, the balance sheet describes the company's financial position at a point in time. So the balance sheet is like we take a picture of the accounting equation at a point in time. So typically at the end of the accounting period, so December 31st. Okay. What the balance sheet does is it describes which assets do we have, what liabilities do we have, and what is our equity balance, okay, at a point in time, typically at the end of the accounting period. So if we look over here, look at our example balance sheet for fast forward, we can see we have our assets, and see the balance sheet is showing the accounting equation broken out. That's what it's showing you. We have our assets, liabilities, and our equity. So our assets, we have our cash of $4,800, our supplies of $9,600, plus our equipment gives us total assets of $40,400. And now total assets equal $40,400. We know that total liabilities plus total equity must also equal $40,400 because the accounting equation says that assets equals liabilities plus equity. So what are our liabilities? We have our accounts payable of $6,200. That's our total liabilities. That's the only one that we have. And then, see, we have our equity of $34,200. Where did we get that? We got that from page 16, showing our balance in owner's equity from our statement of owner's equity, $34,200 ending equity. So that number, the ending balance in owner's equity from the statement of owner's equity comes onto the balance sheet here in owner's capital. We add that $34,200 of equity plus our $6,200 of liabilities gives us our total liabilities plus equity equal to $40,400, and then our accounting equation stays in balance. The last financial statement is our statement of cash flows. This statement of cash flows we will talk more about in Accounting 102. So the next principles of accounting course, okay? But what our statement of cash flows shows us is shows us where do we get our cash from and what are we spending our cash on. So cash inflows are cash coming into the organization, cash outflows paying for things, cash going out of the organization. So if we think in the statement of cash flows, divides our cash inflows and cash outflows into operating activities, investing activities, and then financing activities. Our statement of cash flows also shows us our beginning cash, so cash at the beginning of the year, plus our changes in cash. Where do we get our cash from? Operating activities, investing or financing. Beginning cash plus changes in cash would then equal cash at the end of the accounting period. So the other thing that the statement of cash flows does is it shows how we got from beginning cash, the start of the accounting period, to ending cash at the end of the accounting period. Okay? And again, we will talk about statement of cash flows in Accounting 102, but I did want to just introduce you to it at a very high level here in Chapter 1, okay? So I'm going to end this lecture video now, and then the final lecture video for Chapter 1 will be covering the quick check problems on the next page, page 18, and page 19, page 20. Thanks so much. Bye.